It's been said that temperament, not intellect, is the most important quality that an investor can have. And temperament, when you think about it, is closely connected to our behavior and our habits. And that's the purpose of this video series titled Habits of the Investing Greats. I'm going to give you one habit in each episode. I'm going to link that one habit to an investing great, and then I'm going to tell you what to do about it. I'm Ron DeLegge with ETFguide TV. Be sure to subscribe to this channel, and if you haven't done so already, post some comments. Let us know how you've been enjoying this channel and some of our content. Be sure to check out my portfolio grading service at portfolioreportcard.com, along with our other fine programming like ETF battles, content that you will not see anywhere else. Now, I want you also to find ways as we go through these habits to practice them on a weekly basis. Make them part of your routine and part of your investing regimen. Today's habit is perseverance. And we're going to link this habit to the investing great by the name of Ronald Read. Now, some of you have asked me about him, and we're going to talk about his story in just a minute. He was not born into wealth. He was not born into fame. And I think that's one of the misnomers about investing greats, is that they're famous or they're worth billions upon billions of dollars. And that's just simply not the case. And when I wrote this book, Habits of the Investing Greats, that was one of the main points that I wanted to convey, was the fact that anybody, including you, could become an investing great. And so Ronald Read achieved tremendously profitable results. And like I said, we're going to look at him and his story and find out what we can learn from that. So let's just get into it and take a look at some slides. So perseverance, that's the habit here. And when we think about it, perseverance is much more than patience. Patience is just waiting. Perseverance means to wait despite adverse or harsh circumstances. And you could make an argument that it's easier to be patient than it is to be persevering. Now, they're both important if you want to have profitable investment results, but they're definitely not the same thing. To persevere as an investor requires a much higher level of patience. It also requires time. Yet time is the one thing, it's the one commodity that's in short supply for all of us. Once time is lost, it can never be regained. Even if you have unlimited resources, you cannot buy more time. And so as a result, investing greats let time work to their advantage in at least two different ways. The first is that investing greats focus their time and their efforts on high payoff activities. They do this instead of spending time on unprofitable ventures with zero hope, and they allocate their attention and their resources to businesses or opportunities that offer the highest probability of profits and the best chance of profits. That's the first way that investing greats focus. So we can learn that. The other way, and this is the second focus way, is that investing greats allow time for their investments to grow. This is especially the case even when the value of their investments is negatively impacted by short-term shocks in the stock market. Instead of selling valuable assets when they're down in price, investing greats persevere. Or as John Bogle, another investing great, put it, time is your friend, impulse is your enemy. And so ordinary people are in fact quite capable of achieving extraordinary results. And investing great Ronald Read from Brattleboro, Vermont, is evidence of that. He provides us with an exceptional example of someone that had the habit of perseverance. So this was a little bit about Ronald Read. Despite earning a humble salary as a janitor, he quietly amassed a fortune of $8 million that not even his family or friends or neighbors knew about until after his death. So how did he do that despite having a humble job as a janitor and earning a humble salary? Was it by gambling his earnings on lottery tickets? Was it by day trading? It was none of that. It was by simply buying high-quality dividend-paying stocks and hanging on to them through good times and bad times. He also reinvested the dividends. He persevered. And so he kept up with this regimen of persevering. He had some discipline, and it was certainly a 1-2 knockout punch that added greatly to his results. Now, on the surface, someone might think that Ronald Read, as an investing great, is not prone to making mistakes. Well, that's not true, because even investing greats make mistakes, and sometimes they buy stocks that blow up. That happened with Read, in fact, when his shares in Lehman Brothers became totally worthless after the company's bankruptcy in 2008. Now, thankfully, Read's portfolio was diversified, and so even though his investment in Lehman Brothers went bust, it didn't blow up the rest of his portfolio because he was diversified. After his death in 2014, Read's family was amazed to learn about all this hidden wealth. The Wall Street Journal reported that he owned at least 95 stocks at the time of his death, and many of which he had held for years, if not decades. Among Read's portfolio holdings were venerable companies like Johnson & Johnson, Dow Chemical, JP Morgan Chase, Procter & Gamble, and CVS Health. Read made a name for himself also as a philanthropist, and he bequeathed $2 million to his stepchildren, caregivers, and friends. He donated $4.8 million to Brattleboro Memorial Hospital and $1.2 million to Brooks Memorial Library. So he was pretty generous with the money that he had amassed. And so what is the lesson for us as investors? Well, first of all, make mental and financial preparations for the tough road ahead. There will be a rough road ahead, and we know that because it happened in the past and it'll happen again in the future. Realize that market upheaval is a part of the market's history. It'll be a part of the market's future. It's best now to prepare for that versus being shocked and surprised by it later on. Resist the urge to sell your investments at the worst possible time after or during a bear market. This, by the way, is one of the reasons I stress so much the crucial role and necessity of having an adequate margin of safety or cushion inside your portfolio. All investment portfolios should have this, especially those of us that are approaching or already in retirement. We should absolutely have a margin of safety or cushion that's much larger than people that are still in the accumulation phase of their investment plan. This can help you to weather the storm without having to sell wonderful assets at depressed prices during a bear market. And be ready to live through a prolonged market downturn by having, again, this adequate safety net. The typical bear market historically is averaged about 1.8 years, but we really don't know in the future if bear markets will last perhaps longer than that. We certainly hope not, but it's something that we need to think about and be prepared for. And appreciate that the sacrifice of enduring is great, as is the reward for doing so. So persevere. Be patient, but persevere knowing that it's an extra step beyond patience. And that does it for this episode of Habits of the Investing Greats. I hope you've enjoyed it. We've talked about a lot of good things on today's program. Ronald Read, an excellent example for all of us to follow. Be sure to like this video if you enjoyed it. Check out my book, Habits of the Investing Greats. It's available at Amazon.com. It's 5-star reader rated. I think you'll enjoy it. And subscribe to ETF Guide TV if you haven't done so already. I'm Ron DeLegge. We'll catch you next time. Thanks for watching.